Hello, everybody. We are live from the CBOE, from the very quiet CBOE today. Volume might be the lowest volume day of the year. I know I've said that a couple times before, but it is really like almost to the point you could hear a pin drop in here today. Hopefully, everyone is doing well. We're still busy. We're still trading, but boy, it is really, really quiet down here. Hello, Kevin, Steve, Mike, Danny. Got all the usuals in here. MH, awesome, awesome. Um, boy, I mean, what a resilient market, right? S&Ps are really on their high of the day up here. They're up 15 points now. Again, very very low volume, very light volume, so kind of hard to really get a great gauge. The Nasdaq clawing back to another all-time high. The S&P is fighting for that all-time high. It's kind of right there. I think all-time closing high. And here we are, guys. Here we are. Tariffs, certainly, as we talked about yesterday, are front and center, especially with August 1st now right around the corner, but there's still continual news. We got Brazil late yesterday, but as I mentioned yesterday, until we see something with China, the EU, Canada, I don't think that it's going to be a big market mover, but who knows? VIX is 1578. You all should remember, all should have in mind that that 16 number in the VIX, that 16 number represents what? What does everybody know about that? Wow, is it quiet? Wow, surprised there's not lots of pranks and games going on back here. But what is that 16 in the VIX, everybody? 1% move, daily move in the S&P. That is right, and that's kind of right where we're at right now. So we'll see if that holds. But let's hit it, guys. Let's hit it. Um, we hit tariffs yesterday. Today we're going to talk about interest rates, and with all of the banter, I guess you could say, between President Trump or by President Trump towards Jay Powell. We're going to talk about what would happen if rates actually came down as much as the president wants. So before we do that, if you guys could all hit the smash and the like button, all that good stuff, that would be awesome. Thank you, Hulk Smash. Yes, love that. Love that. So let's get into this here, guys, because this is interesting stuff here. Okay. We know Powell is the lame duck president of the Fed, chairman of the Fed, right? President Trump really wants him gone. If he did wind up firing him, that would probably be a very, very negative reaction for the marketplace, for the US dollar, for treasuries. So I don't think that's going to happen as much as he wants him gone. But President Trump's latest but I'm trying to choose my words carefully here. Latest barrage of interest rates should be 3% lower than where they are right now. Doesn't really make a lot of economic sense. Okay. Just like the last 2 days here, guys. This is rant would be a good one, Jake. Rant would be a good description. Um, just like the last 2 days, this is not political. Okay. I'm reporting the news. Okay. So over the last several days, President Trump, who is no fan of Jay Powell's, has been calling for a 300 basis point interest rate cut. Okay. Now, that's preposterous. Let's just call it what it is. Okay. We've never seen anything like that before. In fact, that would be 3 times larger than the largest cuts we've ever had, which have happened 2 times before. A full percentage point cut, which is 100 basis points. Okay. We saw one back at the beginning of COVID, March of 2020. Okay. And we also saw one back in the great financial crisis in 2008. Okay. Those were the largest cuts. President Trump wants 3 times that. Okay. What would the effects be from that? I mean, there's some pretty dramatic effects. Okay. But let's talk about where we are first. Okay. Hey there, Aladdin. How you doing? Okay. Right now, our debt is out of control. There's no question about it. Our annual interest expense on US debt has reached $1.2 trillion over the last year, and we now pay $3.3 billion in interest per day. That's not a typo. Those are the facts. I mean, it is ridiculous. And with the new big, beautiful bill passage, our debt is going to increase considerably. It is going to increase considerably. So we're kind of moving in the wrong direction there, in my humble opinion. God, I got to get this cord out of here. Okay. So the president says that if we get a 300 basis point cut, and again, just to remind everybody, 100 basis points is the equivalent of 1 percentage point. So basically, a 300 basis point cut is 3 percentage points. Okay. Now, he's not wrong. He's not wrong when he says that a 300 basis point cut would save 360 billion per point per year, or 360 times 3, over $1 trillion per year in interest payments. Okay? So that is absolutely fact. That is absolutely fact. However, there are some numbers there that need to be clarified. Okay. So, what President Trump did was he was referring to the complete debt that we have, the 36 trillion, which is the number, which is now going up to over 40 trillion with the new tax package that was just passed. Okay. But, but the way that our debt is calculated and the interest that the US pays on our debt, it's only publicly held debt that matters. Okay. Not that it's that significant, but it is. That's really around $29 billion. Okay. And this graphic that I have up there, if any of you have ever visited this website, the FRED, it's the Federal Reserve. I'm not sure what the ED part of it is. The FRED website, you can get more information, more data than you'll ever want. But it is a great, great website. Okay. It is a great, great website. So, yes, President Trump is right in the way he went about the calculation. He's not right using the base amount that he did. Okay. Now, if we look at what we are paying, okay, with all the debt that the US has issued over the last number of years, the average rate on our debt is about 3.3%. Okay. Right now, the Fed funds rate is, the target is 4.25 to 4.5. The likelihood is that in the July meeting in a few weeks, there's not going to be a cut. September, there is a high probability of a cut, but the cuts that are out there and kind of baked into the market right now, we're talking about 25 basis points cuts. Okay. Now, here is the calculation that if we did go from 3.3%, if rates were cut by 300 basis points, then yes, 800, almost $1 trillion a year would be cut off of interest rate payments. Okay. Does everybody understand that? I know it's a little, little getting into the weeds with economics and the Fed, but listen, we do pay a ton in interest payments on our debt. And just like anybody else, just like you or I, if we have a loan out there, whether it's our mortgage, our car loan, whatever it is, rates come down and you're able to refinance, you're going to save money. You're going to save money. No question about it. Okay, so if that were to happen, which sounds great, like, well, yeah, why not? Let's just lower our lower the benchmark rates, right? But what cost? What would happen to the markets? What would happen to the economy? Okay, if something like that happened. Okay, well, put a couple assumptions in here. Let's assume that 300 basis points of rate cuts are applied to only 20% of the US debt because there's no way, okay, there is no way that the US could refinance all their debt at once. Impossible. Impossible. It would overload the system and somebody just thank you for the Federal Reserve economic data. Um, it would overload the system. So let's say that the Fed is able to refinance 20%. Okay. That 5-year cumulative savings on interest rate expenses, significant amount, about $2.5 trillion. That's kind of the real number you have to look at because there is no way, zero, no way the Fed can refinance all the debt at once. Okay. But what kind of cost would this come with? We know what these savings could be. Okay. Let's go back in history here. As I mentioned earlier, 100 basis points, 1 full percentage point. Okay. That is the largest single cut in history, which happened back in the financial crisis of '08, back at the beginning of COVID in 2020. The Fed has also never, ever put in a rate cut of 75 basis points or more when it wasn't a recession. And we are not in a recession right now. Okay, we are not in a recession. And David, yes, hyperinflation would probably be one of the consequences of doing this. Because if we go back to kind of the rationale for why the Fed lowers or raises rates, why is that? Well, they raise rates to slow down the economy, to slow down inflation. They lower rates when things are stagnant, when they want to boost the economy, when they want to boost spending. So, just as a little review, what happened after COVID when rates were, cut down to basically zero and a lot of people got free money, PPR, right? What happened? All this spending, right? All this the unintended consequence of all that spending was hyperinflation. So the rapid rate increases, okay, the rapid rate increases that we have seen, we're trying to slow down the economy, which really has not happened. Really has not happened. Okay. So again, here is another great graph, another great data point from the Fred, not the Fed, but the Federal Reserve. What was it again? Someone posted Federal Reserve economic data. Thank you, thank you, thank you, thank you. Okay, showing what happened here with rates over the last 25 years. Okay, so what would happen to the housing market? Okay, sure, great thing. We could see rates finally 30-year, which most people are getting 30-year mortgages, but even though mortgage rates are based off the 10-year, but what would we see? We could see mortgage rates back from 7-ish percent where they are right now. Maybe they go down to 4.5%. Okay. That would be great, right? We would all love that. We would all love that. However, that would have to be balanced with a market, with a real estate market where we've already seen prices at all-time highs. We've already seen an explosion in home prices. Okay. And what would happen? All of a sudden now, you would probably see home prices go up further because now all the people that are not able to afford a home, that are priced out of the market, because of where mortgage rates are, now you're going to get all these buyers coming into the market. Well, what does that do? It's supply. It's the old tried and true explanation definition of supply and demand. All of a sudden, there's going to be even more demand than there is right now. Probably pushes prices up. So mortgage rates drop, prices are probably going to go higher. I don't know if they balance out, if there's some discrepancy there, but it's probably not a big boost for the housing market. Okay. It's probably not a big boost for the housing market. What's really interesting to me while we're talking about rates right now, I shouldn't even say most of us, because I don't know the ages of all of you who are listening in right now. I know I'm old enough to remember when mortgage rates were in double digits. So when we look at mortgage rates right now at 6.5 or 7%, historically, that's not really out of line. That is not really expensive. But, when we're coming off a period of time where many of us were able to get a mortgage or refinance, whatever it was, at 3%, 3.5%, and now that has basically doubled. Boy, that's really it's like a sharp stick in the eye, right? But historically, if you look at that 6.5 to 7% range, it's not really out of whack. Late 70s and early 80s. Jake, that's right. I can remember in the early 80s having a savings account at the local bank and getting paid 10, 12% on that. Okay. Now, if this happens, if rates get slashed by that much, what happens to the US dollar? Even more so than we have seen right now. Okay, the US dollar will get hammered. Why? Because as someone put out here before, we will probably see hyperinflation. Okay, which if that happens, dollar softens, inflation, what's going to happen there? Probably see another or a continuing spike in the price of gold. And even though gold is up about 40% in the last year, almost 80% in the last 5 years, a massive interest rate cut would provide big tailwinds. Big tailwinds. All right, let's get to our word here. Thor says our word of the day is rates. Let's get that up on the screen for everybody so you can be in the wheel. Man, is it quiet? I'm not sure. I don't know if you guys can all hear, in the background, although today there is really nothing to hear. It's actually a pretty thin crowd today. There's a lot of people missing out of here. What's going on? Are you going to be at the golf outing? Fixed. Yeah. Bingo. All right, we can tour it up again. Yes. CBOE golf outing coming up here that a lot of people are looking forward to, me included. All right, let's go back here. Okay, so going back to the US dollar, okay, the dollar is already down almost 11% this year. It is the worst start of the year to the US dollar in over 50 years. Okay, we could see the dollar decline another 10% if this was to happen. No idea, Harry. No idea. So it's kind of the situation here where we have to be careful what we wish for. It really is. Everybody wants lower rates. Okay. And a gradual decline in rates. Great. All for it. Me personally, and probably, many people that and that you trust. Okay. However, a shock to the system, like 3 percentage points, even 2 percentage points, even if we got a cut, if for whatever reason, okay, if for whatever reason the Fed came out in September, and I'm going to take July off the table, okay, even if they cut by 1 percentage point, I think the market would sell off really heavily, because if they did that, that would give the perception of panic. That would give the perception of bad monetary policy. That would give the perception that the dollar is weakening. So this has to be moderate. It has to be moderate. Any questions on rates here, everybody? Any question on any of this, on what the market's pricing in? In fact, let me go to that right now, to the CME FedWatch tool here. Hang on one sec. Okay, here is the CME FedWatch tool. Okay, so this is the July. This is the July expectation. So the meeting's at the end of the month, July 30th. And this is showing us that there is and the wheel's going to close here in a second, guys. This is showing us a 93% probability of no cut, rates staying the same. Okay, if we move that up to the September meeting, okay, here is where the market is pricing in a cut. 64% probability of a quarter point cut, or 25 basis points. Okay, and a small probability, 4%, that there could actually be a 50 basis point cut, which leaves 31.6% that there's going to be no cut at all. So that is what is factored into the market right now. If we go out to October, really not much movement there. Okay, an additional 40% that maybe there's going to be another cut. December is where that really, the odds that are baked into the market, that's where it really picks up. So right now the market is anticipating 25 basis point cut September, 25 basis point cut December. Okay. Anything gradual, Aladdin, anything gradual is usually the best practice. Okay. Kevin, I think we can agree to disagree on that. I wouldn't say that the dollar decline is on Powell at all, but that's just my opinion. Okay. Yank the Band-Aid, Jake. You mean like just let them rip, let those rates just come down? Wheel's closed, by the way, guys. Wheel is closed. Yeah, that would be tough, Jake. That would be really, really tough. All right, before we head to the wheel, those of you that are interested in trading futures, Dan O'Brien, our phenomenal futures trader, educator, pro, has a webinar this evening. The link was just posted up in the chat here. If anybody is interested in joining in, hearing what Dan has to say and Dan's system that he has built, which is his Karnak system is an auto trade system, something to listen into. If you're interested in trading futures, Dan is the man. Aladdin, appreciate that. Appreciate that very much. Thank you, Kevin. I will let Dan know that. And our behind the wheel peeps, one of them's right over here, Michael Clark, who runs this for us, who, the other day we wished him a happy birthday. So yeah, we have great people behind the scenes as well. All right. Mike, are we good to go with the wheel? Beautiful. Gonna bring that up right now. Yeah, this one's not as packed as the last couple days, I don't think. Wonder if that's the topic. I don't know. We got to get more people on here, but here we go. Let's run today's wheel. I'm getting busy watching this. Gene, Gilbert, Jake Jacobson, John. Who is it? Okay, we have John. Thank you, Kevin. Thank you. Thank you. John, just John. Are you here? We're going to call you JJ, just John. Jake, you were close. A whisker away. We're waiting for John's confirmation here. John, are you here? I do not want to have to spin this wheel again. Mike, do we know who John was? Oh man, this is like a dine and dash. This is totally dine and dash. All right, John, we're giving you 5 seconds here. 5, 4, 3, 2, 1. John, you are out. Wait, there he is. There he is. Just caught it. John Coate. There we go. John. Wonderful. You just made it. So Michael posted up here. Send me an email at prosperswag@prospertrading.com. Let me know your swag size and your mailing address. Not him, or it is different John? Oh, hang on. John Coate. Hang on. I'm hearing that there's regular John. Oh, there's regular John, not John Coate. Okay, regular John. Okay, regular John. What is your last name? Regular John. Could call you RJ, could call regular John. I know you're here. That's great. Let us know your last name. And do you see the email address for you to send me an email with your swag size? And yeah, like RJ, exactly. With your swag size. Not sure what that not sure what any of that is, but we'll try and get this figured out, folks. We will try and get this figured out. All right, everybody. I know, John, we know it's you. We know it's you. You'll send me an email. You've got all the information there. All right, everybody. Thank you so much. Appreciate it. I wish it was busier down here today, but not much going on. John, it's you 5 times. We got you. But anyway, yes, live from the CBOE trading floor in the S&P 500 options pit. You're very welcome, Jake. My pleasure. Try and make things as interesting as possible. All right, everybody, have a great day, and we will see you tomorrow.